You're listening to Energy Insiders, a weekly update on clean energy and climate policy with Renew Economy's editor Giles Parkinson and leading energy analyst David Leach. Energy Insiders is brought to you by Evergen, providing cutting-edge energy management software for battery optimisation, virtual power plants and distributed energy resources. And Pylon, helping solar installers and retailers design high-resolution solar proposals in minutes.
Hello and welcome to this latest episode of the Energy Insiders podcast, the very last one before the federal election, I should add, so it's going to be of some interest. My name is Giles Parkinson. I'm the editor-in-chief of Renew Economy and editor of its EV-focused sister site, The Driven, and joining me, as usual, is ITK Principal David Leach. We're lucky to catch you, David, because you're off to visit another state for some more model plane flying.
And we voted already, Giles, and you know what a wonderful process it is voting in Australia compared to the United States. The AEC officials are very friendly and helpful. There's lots of placards in the areas where I go, but essentially it's all done in a very respectful manner. And
but David, you missed out on the sausage, the democracy sausage.
Yes, I have missed out on the democracy sausage and no doubt the packet cake. I don't think the cakes are as good as they used to be once upon a time, Giles, but I couldn't possibly be me getting older, but I have a romantic.
Oh dear. That's a harsh assessment, David. I think there's going to be some people quite crestfallen by that view.
Well, in that case, perhaps we better get back to talking about our energy, and I think we've got a great interview this week with Rick Wilkinson, the CEO of EnergyQuest, a gas consultancy. We're talking about gas, which we don't always do, and Rick is very well qualified to talk about it with his background at Santos and as one of the key developers of the Santos's GLNG, Gladstone LNG consortium that was, possibly one of the first guys to, not necessarily the best LNG project in Queensland from an economics point of view, but the first one thought of almost.
Okay, then. Well, as you say, we don't often delve inside the gas industry, and Rick Wilkinson is as good as any person to give us an insight into what's going on there. So let's have a listen to your interview with Rick Wilkinson from EnergyQuest, and we'll be back with the news of the week afterwards.
Rick Wilkinson, CEO of EnergyQuest, thanks very much for joining the Energy Insiders podcast. Perhaps you could start by telling me a little bit about EnergyQuest and what it does.
So EnergyQuest has been studying the energy industry of Australia with a close focus on gas for 20 years now. We started life as data scrapers, trying to bring together all the different pieces of data that exist in government databases, company databases, what was generally publicly available, and pulling it together into coherent reports. And since then, it's evolved into longer-term modelling and also consulting for the industry in general.
And I think you have by and large, EnergyQuest has a background with Santos, and I think you were in charge of the GLNG and Queensland portions of Santos at the time that GLNG got going. Have I got that right?
Yes, that's correct. And there are a few different players from the gas industry itself, specifically Santos. There's a little bit of past history there, but generally our focus is right across Australia.
Yes. Now, of course, in Australia, gas, I don't want to use the words like at a crossroads, but in recent years there's been constant talk about a decline in existing southern supply. I thought we might structure this conversation a little bit like a piece of analysis and talk about supply and demand. And conventionally, I think it's normal to start with the outlook for gas demand first of all. But of course, I think that you can't really separate demand, supply and price. They're all sort of mixed up with one another. But what's EnergyQuest's view about, let's talk about what's going to happen to gas demand broadly. Like, let's start by, if you like, ignoring the LNG side of it, and let's just talk about what Australian eastern domestic gas demand, is it going to grow? How much is it? And do you think it's going to grow, be steady or decline?
So generally the outlook for the domestic demand side we see as relatively flat. That's basically the growth in the economy offset by increasing renewables, more efficient uses of the energy. So generally flat to a longer term outlook of decline as the renewables start to bite further and further into that marketplace. What's distinctive, though, is also not just about the total volumes, but also about the how we handle the peaks. And we swim quite heavily, at least on the gas side of things, to meet Victorian demand when they go into the cold winters there. And so a feature of the energy market is not just meeting the total volumes, but what we do in those cold winters.
And in my opinion, the seasonality of gas demand is likely to increase because it is a fact that renewables production goes down during winter. And so it's more likely that we'll be using gas electricity generation during the winter months. And so I can see that peakiness and seasonality increasing. Would you agree with that?
Well, we do agree that the peakiness needs to be handled, and gas has certainly got a role to play in that. What's interesting is that it's the capacity to meet, or the firm capacity, as you rightly pointed out, happens in winter when we actually start to get less wind, ironically, and less sunshine. So the variable renewables had more difficulty in getting enough supply in the middle of winter. And then you need to turn to something that's firmer that you can deploy, and that can be hydro and obviously gas to do that. What's interesting is that as you load more and more renewables into the system, it's not so much that the volume goes up in gas, but actually the requirements for the capacity when you push the button. So the firmness of capacity, ability to add into the energy market when you need it is what's important about gas.
And so that's right. We might talk a little bit more about power versus energy later on, but the immediate problem when we think about the peakiness is that the marginal sources of supply come from Queensland, typically, let's say, or Northern Australia. Whereas, as you pointed out, the demand in winter comes from in the south of Australia. And the problem is, as much as anything, is the pipeline capacity, isn't it? And the inability to store gas. It seems storage is a problem everywhere, to store enough gas in the south.
Yes, that's true. We do have storage in the south. Iona out at Port Campbell is the biggest storage facility in the southeast, and that is working at close to capacity. There are plans for another one to come on at Golden Beach, but still hasn't reached financial closure. So without storage, you then have to bring the gas from wherever it's available. And for us, that means very long gas pipelines coming down from Queensland and potentially in the future from the Northern Territory to bring that gas down. And we're already running that infrastructure capacity. Because really happening is that as we go into winter, the LNG suppliers are able to provide gas to the southern markets because it's the northern hemisphere summer, and so LNG loads are quite low. So what they're doing are swaps. They're making the gas available to help meet the peakiness in Victoria and New South Wales. But when the soft period comes in our summer, then they want that gas back because that's when the peak load is needed for LNG capacity. And that's working quite well, even though when you look at the charts and look at the data, it looks like there isn't that much gas coming from Queensland. It's the actual capacity of gas that's being made available that's absolutely critical to keeping lights on and keeping the showers, hot showers in the south.
And so we talked about demand. And we start drifting off into supply, you and I both, automatically. But and we got there through talking about the seasonality of demand. But and the reason why people have a forecast that demand will be flat or declining in the longer term. One of them is that we've got an electrification process going on to which people have subscribed to a greater or lesser extent. But the other one is a far more prosaic demand limitation. I mean, if I was being an analyst, I'd say demand destruction in investment banking because the price is, three times higher, let's say, than it was 10 years ago. before, do you think that the high prices are associated with making it difficult to contract the suppliers, and in general making it difficult for gas consumers? And I suppose households don't mind so much because so much of their bill is in the pipeline side of things, but for business and industrial users, prices at the moment are not that encouraging, are they?
No, they're a struggle, and you're right to say that the gas prices have increased quite substantially. But we had a very blessed period where we had the likes of Gippsland Basin, which was one of the great petroleum resource areas of the world, and produced billions of barrel of oil and trillions of cubic feet of gas. And so that situation close to the demand centres was just ideal, but it couldn't last forever because it's a finite resource. Similarly, on the Cooper Basin, which was supplying New South Wales and South Australia, again reaching the later stages. And that forces the gas prices up as you go looking for more difficult gas, further away gas. So it's a natural progression that moves part. You might people talk about a high price of gas, but there is nowhere else in Asia, our part of the world, who has gas prices cheaper than what they are here in Australia. Uh, Most of the other parts of Asia are importing gas or importing LNG, or they have their own struggles to bring on particular gas. And the only exceptions where free market where the gas prices are lower, of course, North America, because they did the shale gas development. And then from there, you need to go to uh, subsidized or controlled economies like Saudi Arabia or in the Middle East, where the gas prices are lower. But certainly, gas in Europe, certainly gas in Asia is much more expensive than it is here in Australia.
And so when we look at the outlook for prices, so we're going to gradually drift into supply from demand. And I mean, electrification is a thing as well. If I look at AEMO's forecasts, which they see, I don't want to speak too much about individual numbers, but perhaps we'll come back to that a bit later. But if we move from prices towards supply, one of the answers, you can either have imports of gas via LNG and regasification, and we're moving close to Port Kembla to being able to do that within the next 12 months, or we can get more gas from existing sources. And I don't think in southern Australia, with the exception of maybe we'll run round them, but first of all, what would you expect? What are you saying about Port Kembla at the moment, Rick? I mean, it's been built. I'm not sure whether they've actually contracted their floating gas regasification terminal, I think it's called. Don't know whether they've got one, but clearly there's going to be a terminal at Port Kembla. Do you think they're going to have many customers?
Well, firstly, how's the project tracking? Well, yes, they do have the vessel, which FSRU, Floating Storage and Regas Unit, is already on contract. It's called the Hogue Galleon, and at the moment it's actually in Egypt, helping Egypt meet its domestic gas demand. So the project is, in a sense, finished, and with a little bit of notice, we could have that vessel alongside as early as winter of 2026. So in terms of the mechanics and nuts and bolts of all of this, it's ready to go. The problem becomes, to contract it and who's going to contract for it. These are big fixed cost units, so the more gas you move through them, the lower the costs are. And you need pricing signals so that people can say, well, I want to avoid paying high price or premium prices for gas. I'm going to try and use an LNG facility to regas and meet the supply there. We don't have that problem.
No, I just want to talk about this import price of LNG and regasification, because the biggest component of it is the underlying gas price, the LNG price, whether you buy it from West Australia or from Queensland or from Texas or from somewhere else, and that LNG price itself can be based either off the Henry Hub gas price, or it can be based off oil, can't it? I mean, want to get too off track here, but my point, I think, is that if you look at the oil price, it's quite volatile, and even the Henry Hub gas price is quite volatile as well. So that you've got a volatility in import prices, and I wonder who's going to bear that risk.
Certainly there is a different type of volatility, and there is a impact if you're contracting longer term and using, say, Brent or the Japan crude cocktail as your bench, you're going to get some movement in that volatility. Henry Hub similarly, but you have quite deep markets there. So if your volatility is your problem, then you certainly can write hedging contracts and help manage that out, depending on the term and the length as to which you want to go there. Of course, the government seems to have a track record of intervening in markets. So if they want to push gas from Western Australia into the East Coast, and they can write or whatever rules they seem to as to what it might be linked to. So there are a bunch of different options. Which one is going to fold at this point? A little bit early to tell.
Yes, Rick, but I think the perhaps subtlety I was trying to get to is that someone has to bear that risk. Like traditionally, when we had BHP, Esso gas or Cooper Basin gas, very long-term contracts, at least initially, like 20 or 30-year contracts were written. But it's hard to see who was going to bear the pricing risk on imported LNG and write a long-term contract. I mean, AGL, for instance, typically it would be a role for a gas retailer, but when I look at those guys, AGL doesn't want to be in a big gas retailer, it seems to me, at the moment. And Origin is going to think about writing a contract in terms of its position in APLNG. I'm just wondering, do you think about that?
Well, I think the volatility is an issue, and we see in other examples already where increasing margins are being built into pricing structures when there is volatility, and we see that already in South Australia, in the gas market over there, where the volatility of going in and out of renewables into gas-fired power and back has meant that the cost of futures of hedging in that market means that they have one of the highest retail margins in the NEM. So that's an example where that volatility you're talking about, David, actually exists and turns into higher costs. Again, you leave a bunch of commercial people alone and tell them where your optimum outcome is. They'll generally find a way to hedge or offset, get the nicks right to meet the market, and that's a good thing, I think.
And so that Port Kembla terminal, which is the only one really to talk about just now, I think can meet, if we're talking numbers, I seem to think that the ex-LNG total demand at the moment is roughly 400 petajoules or something. I'm just speaking. I should have looked at my tables. What do you estimate it is going to be?
Sorry, which demand are you talking about, David?
I'm thinking the Australian demand, excluding LNG and excluding West Australia.
Oh, yes, that's 500 petajoules approximately.
500 petajoules, and the maximum capacity at Port Kembla is about 130 petajoules a year, is it?
Yes, that's right, which is quite a big percentage of that total market, to be honest.
I think it is as well, but I haven't seen anyone announce a contract. Good news travels quickly. That's one of my investment banking rules, and bad news travels slowly, but I haven't seen many announcements. Have you?
No, and that's one of the real challenges for projects like this. There are very few buyers of that sort of volume of gas. Once you go past the Origin Energy and the AGLs, the big retailers, there's very few sizable entities that could actually step in and move the dial to make that all work. The problem is, of course, 500 petajoules is not a very big market by global standards, and so something as large as an LNG alongside, that's a problem. What you've got to do is start to get across the passage of your selling capacity, because LNG ships, regasification units, are very good at responding quickly to the market. They can turn on 500, 400, 600 terajoules a day, which on a peak day is terrific. And we already have LNG regas terminals, one in Greens Road, Dandenong, and there was one at Newcastle that AGL had for a while, that was specifically there to meet peaking needs. So what you've got to do is perhaps dial it into the analysis, which says it's not just the total volume, but it's actually having it as an insurance, as something you can call upon. Now, that's a problem because at the moment, every time the gas price gets a little high, as we saw in 2022, they intervened in the market. They said nothing above $12. We all sat down and, took on those pricing signals.
Had a Valium because you can't actually make a market work when you put a cap like that on it.
That's just spot on there, David, because who's going to make money at buying gas at $12 and selling it at $12? Doesn't matter if it's storage, doesn't matter if you want to expand pipeline infrastructure or you want to use an LNG. You need a pricing signal for that to work.
That's right, and it does make me think. But we won't talk about it now. Whether Fortescue itself couldn't get in and be a gas retailer because, as you say, there are so few parties you can identify to actually take that on. But as we then move around, when I look at New South Wales, the next cab off the rank, in theory, might be the Narrabri, a very controversial CSG project, which itself could be quite a big supplier to New South Wales and has been sitting in kind of approval queues for about a decade. What's your feeling about, will that project actually go ahead or not?
We have had a close look at Narrabri here at EnergyQuest. We've looked at the subsurface. While the geology is challenging, it's well within the reach of Santos in terms of their technical capabilities. It's a little bit more challenging than what you would see in Queensland. There's a few more fractures.
I think that's because the gas is more fractured, isn't it? The coal is more fractured, and so you for the people who are listening, you can explain it much better than me. But your pipelines to extract the gas have got to start taking Z-bends and stuff like that. And
yes, you've got to understand just where the gas is contained. The other kicker is that it's also got CO2 in there, carbon dioxide, which comes from secondary volcanic action. And so you might drill a well and think you've got gas and come up with 10, 15, 20% CO2, which then has to be dealt with because in these days you don't, it's difficult to release that. You can't clear that one off. So those things are all manageable. I mean, Santos has a great CCS project up in Moomba. They've already started to talk about what they're going to do potentially in New South Wales as a positive thing because there is coal mining in the area and they also might be interested in what they do with their CO2. So subsurface, it's all perfectly doable. You still need pipelines to connect yourself into the market, and that pipelines you need to make sure you can get past the farmers, and there are some challenges there still in the courts with regard to not just farmers but native title that need to be contend with, and so that's hard work. But at the end of the day, in my opinion, it's going to come down to the appetite for the New South Wales government and Santos board when the demonstrators start showing up and you're putting knitting nanas and vulnerable people in front of the blades of D9 bulldozers.
And I noticed, Rick, that when Santos had their investment day, they didn't really talk about Narrabri to any great extent. And we'll move on from there because time is short. But just before we do, what is EnergyQuest's view about the wellhead price that would be required to justify that investment?
I think it's current pricing we're seeing. It's within range, so it can be done. It's with the sort of pricings that we're seeing in the spot and contract markets. I think that works.
That's around $14 or $15 a gigajoule, more or less. Yeah,
that's correct. Yeah, David, that works.
Now, so if we leave Narrabri and keep moving north, we get up to the LNG or producer reserves in Queensland. And you can correct me, but my understanding is that these guys, but particularly APLNG, has some spare 2P reserves. But despite those three producers between them, and it's mostly APLNG having spare reserves, they've nevertheless been buying more from other sources than they've actually been selling back to the Australian market. And this may go back to the seasonality, but so I guess my question really is, how much potential is there for those Queensland guys to sell, if there was a pipeline capacity, to sell more back to Eastern Australia?
Well, the first thing is you're right. For example, APLNG has some very good reserves position. That's not the case for GLNG, the Santos, and increasingly more challenged is the QCLNG or Shell Arrow combination. But the issue is less about the reserves and more about the deliverability, which is what can you turn on and make flow, make it available. Unlike big offshore fields where you have monstrous wells that can produce 100, 150, 200 terajoules a day, a single coal seam gas well is between zero point 0.5 and 1 terajoule a day. So you have to drill wells almost every day in order to keep your production going flat. And so there's an ongoing capital investment just to meet your contract demand. So even though you may have reserves, the problem is that you may not have the deliverability or the well capacity to bring that on because you're trying to optimize your capex to keep your costs down so that you have enough to meet your existing contracts without having a little bit of fat in the system. If you want to pay somebody,
And Rick, it might be just worth talking a little bit more about the coal seam gas wells from this economic and technical perspective. I mean, only to observe that if you shut the fields in, then the water, I mean, the way it works is that there's water contained within the coal, and when you drill a well, you let the water out, and then the water's been holding back the gas that's in the coal, and then so once the water's released, the gas flows up the well. That's my reservoir engineering. But I mean, if you shut the well in, then maybe the pressure will drop, and if it rains a lot, maybe the coal will get wet again. I mean, there can be quite relatively challenging to keep the production going as well as we do it in Queensland.
Yeah, you don't necessarily want to turn these things on and off. So that's a problem once you bring on a coal seam gas well and you get the pressure in the zone. Shutting it down and then starting again is a big problem. But it's once you drill a coal seam gas well, then eventually they're declining at about 5 to 10% per annum. So you've got to keep replacing that 10% decline by drilling more and more wells. And so that's the reason.
And Rick, sorry to interrupt again for the audience, but I can't help myself. The coals have different levels of production, don't they? There are some things like in the Indalla Nose that, like QCLNG, which is now Shell, which might have a lot more gas in the early years, but then a much faster decline. And then there are other areas where the deliverability is much steadier. Is that a thing?
Yes, that's right. Generally, the ones that come on very strong, very fast, like Fairview, Spring Gully, which are world class. It's hard to find a coal field in the world that produces better than some of those fields. But then you're producing them out faster. The ones with lower permeability, like around the Roma area, they take longer to produce. You've got to spend more money. The wells produce less. They just got to be nursed along to make them economic.
And so, sorry for that. But as we go forward, so we talked about the deliverability. So there are reserves there, but they require a lot more capital expenditure, frankly, to produce those reserves, which is no big surprise. And I imagine, and we divide those reserves, Rick, between what are reserves, which is something called proved, probable or possible, and I think the reserves we're talking about are probable, but in coal seam gas world that really means proved. And then we've got 2C, which is contingent resources. And basically the problem is the gas will be there, but for one reason or another, it's likely to be a lot more expensive to get it out. Am I thinking about it the right way?
Yeah, a contingent resource, when you look at the numbers, you see a big number for contingent resources. So all we need to do is just convert that to reserves and all is good. But the issue is that it's a contingent resource, which means it's not commercially able to be produced, is there for a good reason. It's either technically challenged or the costs of making it flow are so prohibitive it doesn't work. At the moment, there is a large amount of unutilized capacity in the LNG trains, the LNG plants on Curtis Island. So if you could find 1 gigajoule more of gas, they would certainly take it if it was available, and they would pay you a premium price, LNG netback price, which is up to that point to bring it on. So that's a very high price, and they can take very high volumes. And it's still not possible to bring on that contingent resource just because of the technical challenges and the costs of doing it.
And so this always makes me think, it's all well to talk about that spare reserve and resource, but I always worry that if from the owner of the LNG facilities point of view, that in fact, when I get towards the end of my contracts, I might find I don't have quite as much there as I hoped I had. I mean, I think these guys underestimate how good it is at the beginning and maybe overestimate how good it'll be in the longer term. I just wondered, is that a way to think about it, or do you have a different view?
Well, there's no question with coal seam gas, as you go away from the sweet spots, they can very quickly get more and more difficult to produce. And there are examples overseas, like the San Juan Basin, where when you moved off the sweet spot, the productivity of the wells dropped much more than what they expected. And they drilled not just thousands, but tens of thousands of well there trying to crack the code to bring it back on. But the sweet spot in the center was really never able to be produced as you moved away from it. And we are always at risk of doing that here, because you basically have to drill the coal as you move along, and you dropping a well in the ground every 1 to 2 kilometers. Eventually, you have to go and drill those difficult areas and find out if it's going to be economic to do so. 2P reserves, proven and probable, means there's a 50% chance you will get less than the number you've written down, and there's always a 50% chance you might get a high side case. So it's far from certain.
So one of the things that's going to happen is the LNG export contracts are going to expire in the mid-2030s. And this is kind of a critical point when you're thinking long term about our domestic requirements. I guess the question I'm asking, outside of APLNG, which has like 5,000 petajoules, which at the current rate of consumption is like 10 years for the whole of the East Coast, is there really going to be so much gas up there that's going to be, even if we put a reservation scheme in place at that time, 15%, that it's going to make that much of a difference or not?
Well, it will make a difference because now you're into the tail gas area. So while it may not have been economic to accelerate the gas forward, there's still going to be gas which comes in after the 2035 mid-30 period you pointed out. At that point, the foundation contracts will have ended, and anybody who wants to export more LNG needs to go to the government and get a permit to do that. And I'm happy to put serious money on it that whatever government's in power will not write an LNG export permit until they're completely satisfied that all of the domestic gas requirements have been met. Now, it might be that whoever is in charge of the coal seam gas fields at the time may choose not to drill as aggressively as what we have had to do during this period when the LNG foundation contracts are in there. So you'll get a decline of that, but it's still going to be much more than what we can possibly use in the domestic gas market for quite a number of years past the mid-30s. This is a problem because now you've changed the market. It's going to change from being quite short of gas and moving it from very long distances, possibly LNG imports, to potentially, if the government gets it wrong, flooded in gas. While that might sound like that's a terrific point to be at, two things to keep in mind: how many customers are going to make it through the high price period to the mid 2030s? So that's an issue. And then secondly, if you're an infrastructure investor and you're trying to build pipelines, they might be completely turned around, or you might have put the wrong pipeline in place as the gas market fundamentally changes when these new large volumes of gas are coming down from Queensland.
So Rick, if we move on from Queensland to look at the next area, it's the Beetaloo, which is in the Northern Territory, and it seems like a long way away, but I was just observing that gas transmission is a lot cheaper to build than electricity transmission, so in the end, transmission wouldn't be the problem in and of itself. But how do you, I'm not necessarily a wild fan of the Beetaloo for a variety of reasons. How are you thinking about it?
Well, I think Beetaloo has a lot of potential, but it's still very, very early days in its appraisal and development. In my experience with coal seam gas and the LNG project, we had drilled hundreds of wells to prove up coal seam gas, and before we even made our final investment decision. And the amount of investment required was not tens of millions, wasn't hundreds of millions, it was billions of dollars required to bring something which was in an area which had a long history of gas production around Roma that with decades. What's different is that in Beetaloo, they've only drilled a couple of dozen wells, and as yet they still don't have a economic well, a commercial well that we can point to say this has been drilled using this technology and is producing gas at a price which makes this field economic to deliver. Now, it may just be a matter of time before that actually happens, but it's still early days, and you still have to sit there and watch the well flow. You still have to make their measurements. And then more importantly, you've got to convince the investors to find the billions of dollars which are going to then be needed to create the development. And you're a very, very long way from anywhere.
Yes, no, I agree with that. Basically, even before I think about other things. And Rick, so we've had a great conversation, and I could do one of these every week nearly and talk about it, that the market as a market, which interests me. But when I listen to what you've been saying, what I hear is that if we can get through the next 10 years, there's the opportunity to have a gas reservation scheme using Queensland gas that with a bit of pipeline augmentation could probably mean that we could get over whatever gas supply issues there may seem like now. The gas price won't necessarily change, but the fundamental problem with supply might go away in 10 years. And so you're not saying this, but I'm wondering if we shouldn't just manage the next 10 years more or less with LNG imports and accept that prices will be high and it will be hard to get a lot of contracts in place or to grow gas demand if that's what people wanted. But we can just muddle through.
Well, I do think there's a good point about LNG imports, wherever they come from, Western Australia or overseas, is rather than force the price up, it forces a cap, because you know that you know with certainty that you can get gas at a particular price. That's important because as you go through a low supply case coming out the other side, you want to make sure that the customers are going to have at least gas available at a price which will keep their business running. But if there's no gas available at any price, which may well be the case, then they won't be there for the gas when it returns. So I see LNG imports doing two things. One is giving a certainty that gas is available at a price, but secondly, very good at reaching the peaking supply needs that you have as renewables become a bigger and bigger part of the energy equation.
Yeah, and I think that's in line with AEMO's forecast that gas power generation demand in terms of gas will go up from the mid-2030s, but not they have a view, not before then. There are other views. Rick, as I said, we've talked for a long time, and I'm always conscious of taking up our listeners' time. I want to thank you. I think it's been a fantastic discussion about gas, and I hope we can do a couple more of them as we go forward.
Okay, thank you, David. It's been fun.
That was Rick Wilkinson from EnergyQuest. We'll be back in a moment to reflect upon that and discuss the other news of the week, including elections, Spain, anything else we can think of. You are back with the Energy Insiders podcast with Giles Parkinson and David Leach. Oh, David, look, I haven't listened to the interview, but I've read the transcript. I don't know what's wrong with me, but I can't get excited about the gas industry. I know it brings in sort of tens of billions or even more of money to Australia for the LNG industry. I guess I'm focused on the electricity markets, and
it doesn't bring in as much tax as it should, Giles. I think that's the great criticism of it from us before we get to the environmental impact. It should be better taxed.
Yes, it should be better taxed. And it's going to have an issue going forward as we sort of hurtle towards, well, we're trying to hurtle towards zero emissions. I'm not too sure we're hurtling quite quick enough. In fact, we know we're not hurtling quick enough. But before we get onto that, what was your big takeout?
My big takeout of it was really that the price of gas is likely to stay relatively high unless the government forces it down. I was interested to hear that there's like 20% carbon in the gas in the Narrabri fields. That really means you've got to drill about 25% more wells, plus you've got all the cost of extracting the CO2 from the gas once it's come up and just reburying it, I guess, putting it just back under the ground somehow. So there was that, and essentially what's going to happen, I think what's likely to happen is we'll stay in a holding pattern with not too much new gas development up until those LNG contracts in Queensland expire. And that means probably that the gas price will stay high relative to historic Australian standards, even if it's low relative to LNG prices. And therefore, we are going to see consumption incentives to electrify and reduce consumption. That's where I got to.
Yeah, absolutely. And if gas prices do stay high, as you suggest, then they don't have a snowflake's chance in hell of beating battery storage. So it's going to be interesting to see the sort of a combination of that, the development of battery storage and all the different services it can do, and as you say, electrification. And I guess that's largely going to depend on the scale of that is going to depend on the result of the election this Saturday. We don't know the result of that. It's going to be fascinating. The polls are suggesting Labor returned. I think a lot of people got their fingers crossed for a minority government, but we don't know what that looks like because there's so many damn permutations and, preferences going hither and thither and how many people emerge. But David, let's imagine that Labor does get back in. It falls short of the majority, which I think would be good. I guess it remains to be seen whether it ends up being pressured by Teals and Greens to go quicker and faster on its emissions reduction projects and a bit more disciplined or a bit more sort of, a bit harder on the environmental impacts, which I think is sort of concern most people. But we don't know yet, and they may just get across the line, or they may be able to sort of pick off people like Bob Katter and some other Conservative independents. Who knows?
Giles, I think, assuming that both the betting odds and the opinion polls are correct, and if we ignore the wrinkle about preferences from One Nation and the like flowing very, very strongly, and I mean, there's always a sub-story to keep it interesting, but assuming we get some form of Labor-led government, then we're going to get at least a continuation of current policy. That's what we're getting. I don't expect that the Teals or the Greens will be able to force much to change in the way of policy towards gas. I think the ACCU scheme could be tightened up a good deal more. That's what I do think is in front of the government. I think the electric vehicle or the emissions standards on vehicles get a chance to actually run for a few years, and we see how that works. And of course, we get continuation of the CIS scheme, and we've yet to see any of those CIS projects actually progress beyond the award of a contract into a project that's getting built. So I'll be keen to see how that gets on, and we'll also be getting a lot closer to seeing some of the transmission built, which is terribly important. Progress on HumeLink, and in 3 years' time, we'll have Project Energy Connect fully up and running, even at Transgrid's glacial pace. Another thing that I think would be interesting to look at is whether the Queensland government, having seen that they are still a federal Labor government led, then becomes a bit more can-do towards renewables in Queensland. Anyhow, this is probably all a good discussion for next week.
Yeah, but look, I'm actually quite interested to note there's still some contracts being written by the likes of Stanwell and CleanCo. There's a doubling of the Wandoan solar and battery complex. There's another wind farm contract written by Stanwell last week. This is despite the pushback from Queensland. We've talked about Chris Bowen doing a pretty good job, and we presume that he will continue in the role if Labor gets returned. He's gotten a bit on his plate, though, hasn't he? Because it's going to be fascinating to see how the ISP is possibly modified. It's going to be fascinating to see the stuff that Tim Nelson comes up with. What he comes up with as part of this energy markets review. But thank goodness we'll have the opportunity for this to happen, fingers crossed. And I guess the irony of it is that we can probably thank Donald Trump and Elon Musk for this, because as we've seen in Canada, more dramatically so, that the Conservatives, who were leading by 25 points, did not win, and their leader got unseated. It was an absolute pleasure listening to Mark Carney on the BBC radio. I heard an interview with him today, and just so intelligent, so well informed, so balanced. That was really quite reassuring.
Giles, the one thing in saying all of this, and I agree with every word you've said strongly, is that we had a fairly similar conversation before Scott Morrison got elected.
Oh no, we haven't done a podcast on it. It's like the Guardian football podcast. God.
I can't remember. I regret deeply the name of the pollster that we had on to talk about it, and we looked at the betting. Remember the betting agencies paid out. So I'm not counting any chickens. Let's
no, let's not count any chickens. Okay, then let's leave that. Let's go to Spain. I don't know. You're a bit like all these other energy experts, saying it's too early to sort of contemplate. But as you sort of noted in our sort of pre-podcast discussion, I'm from the media, so nothing will hold me back. And I've had quite a bit of fun writing about Spain and the fact that it's got very high renewables, it's quite dependent on interconnectors, and somehow it forgot to put any sort of batteries in place and very little demand flexibility. So while they've kind of advanced quite quickly on the transition to green energy, and it's interesting to note that their energy department is actually the Department of Ecological Transition, they've kind of forgotten the smart things, which is like demand response and battery storage. And I've written another story this week quoting the guy who was one of the people responsible for the very first Tesla big battery at Hornsdale, who's now the head of demand flexibility at Octopus in the UK, partly owned by Origin Energy. And he just sort of pointed out that this sort of lack of modern thinking about the grid is really quite stark. And I guess it does tell you that for all our frustrations with what happens in Australia and some of the grid connections and things like that, we've actually come a long way.
Oh, I agree with that, Charles. I've been talking about a distributed grid for donkey's years, well, for at least 4 or 5 years, that batteries on every street corner could make the whole thing, the grid, so much more resilient. We already see that at the household level here. I've got no doubt that batteries can be used to make a grid that's much more resilient. And if there aren't many batteries in Spain, perhaps they'll move forward. But there's been blackouts before. There's a huge one that in North America and Canada in 2003. We had our own one. I mean, there's a whole history of blackouts. Exactly what caused this one and what's to be done about it, we probably won't know for a year.
Maybe not, but look, it's fascinating anyway, and it's look, it was quite amusing. Well, it wasn't amusing; it was quite distressing to sort of see the normal pile-on against renewables, the instant pile-on by all the normal characters. But I guess from that point of view, nothing changes.
And that's why I'm not commenting, Giles. There's a huge pile-on by people who think they know the answer. And just say whatever it is that reflects the t-shirt colour that they're actually wearing most of the time.
Well, sometimes you just got to sort of pick up the phone and say, you're wearing a blue t-shirt. Stop that right now. And here's why. But anyway, David, I think that's probably about enough for today's episode.
Well, I think we should talk about the connection scorecard just very briefly, Giles. You can run me through what the news in that was.
Well, there's been a 37% increase in connection applications over the last year, which is a good thing. A lot of it is driven
up to 50 gigawatts or something, isn't it now?
Now more than 50 gigawatts. So that's projects kind of getting ready to be built because they've got us past the certain stage where they've actually sort of bothered to make the connection application, which is on a simple process. So that's promising.
And they're paying fees. They're putting some money down and getting studies done.
Exactly. So that's good. A lot of it battery storage, standalone batteries, quite a bit of solar hybrids. In fact, that counts for about 2/3 of it, all told. And interestingly, a lot of resubmitted applications from wind and solar projects that now want to add a battery, which is kind of interesting. But I know that the actual rate of commissioning doesn't seem to have improved a lot from the previous financial year. So 2.5 gigawatts commissioned this financial year so far. So I guess got another quarter we might see a little bit happening. But it doesn't seem to me to be, as yet, at the pace required to meet our targets.
No. So that's where we need these CIS awards to actually show that they're more than just merit certificates, that the federal government's handed out and actually have some meaning and get turned into projects that are getting built and constructed. And talking about construction and productivity, we only talk about energy here, but I'd love to be talking about productivity and tax if I could find someone to talk about it, because I think that's a major problem for us. But, within the solar industry, they're picking up the productivity by getting some robots going on the line, aren't they?
Oh, they are. They're sort of doing robots for sort of solar modules. So Neoin was trialling this at Culcan Solar project in New South Wales. Engie's been using robots for drilling pilings and things like that at a solar project whose name now escapes me in Victoria. This is interesting because we are seeing technology cost falls in things like solar and particularly battery storage. We're not necessarily seeing project cost reductions because of the cost of labour, logistics and all the other things. So this increased robotisation, I presume, is going to deliver cost reductions and make it quicker and more efficient. And it'll be a good thing. Bad luck for a lot of the backpackers.
I wonder what we can do in wind farms.
Yes, bit harder there, I think, David. Bit harder. Look, just a quick run through some of the battery stories too. Origin has confirmed that it's at sort of its first stage of the commissioning process for the Eraring battery, which will be the biggest, built next to what is still the biggest coal generator in the country and will be burning coal for another 2 years. AGL has announced the first battery unit has arrived at the Liddell site, which was the coal generator that was closed a couple of years ago, and we'll see.
You mean it's not going to be a nuclear site because the LNP says it's going to be a nuclear site, that therefore AGL doesn't have any opinion or say it only owns the site, what it wants doesn't matter?
Do you reckon if they lose the election, they'll actually just shut up about nuclear now and we can just get on with this sort of renewables transition? Do you reckon that will happen?
Well, that's another topic for next fortnight. I'll tell you the answer to that in a fortnight.
Okay. And just look, one other observation, the other big battery that's going through the commissioning process at the moment is the Waratah Super Battery, which I find fascinating because it will be the biggest single unit on the grid. It will overtake Kogan Creek Power Station as the biggest single unit, be 850 megawatts. It's designed as like this giant shock absorber, maybe the type that would have been useful in Spain. But it started going through its commissioning process last September, and it seems to be not very well advanced. And I'm just guessing, and this is just guesswork because the company won't comment, that it's one of those issues where you've got a contractor or a provider coming to the country for the first time and building something and then just going through the grid connection process and going, Oh.
We've already seen that with a couple of battery projects. As you know, the one in Queensland, the first one in Queensland, took forever to get going, as did the Capital battery in Canberra. Well, Giles, I think our listeners are probably all anxious for us to get to the end of this so that they can rush out and vote themselves. And I hope that we can talk about the future of the industry this time next week.
Perhaps they can answer the big question about the democracy sausage, which is ketchup, mustard, or both.
Giles, it does remind you of the story about the mummy and the daddy and the baby tomato walking up the hill.
Oh, dear.
And the baby tomato falls behind, and the daddy tomato goes back down the hill and treads on it and squashes it and says, ketchup.
I'm going to ask the producers if they're going to let that one through. But I'm going to continue on regardless. Yes, as I was saying, thanks to all the listeners out there. Look forward to your response on that wonderful question. Thanks, of course, to our sponsors, EverGen and Pylon. And we'll be back with another edition of the Energy Insiders podcast next week. It'll be the first under the re-elected or the newly elected government, whichever it happens. Chances are we might actually know the answer by then, but we'll find out. Bye for now.
Energy Insiders was brought to you by EverGen, the market-leading renewable energy software business that optimises residential and commercial solar and battery systems. EverGen enables large numbers of systems to operate as a single fleet, so network operators can use them as a virtual power plant, generating significant value for consumers, network operators, and the energy system as a whole. EverGen software is powering the energy system of the future. Energy Insiders was also brought to you by Pylon. Pylon provides easy-to-use solar design software for installers and retailers with pay-as-you-go pricing, no monthly cost and no lock-in contracts. Join Australia's top solar companies who trust Pylon to design high-resolution, CEC-ready solar proposals.